All right, so for this chapter, we're going to talk about the statement of cash flows. Now, you may recall from the beginning of the course, we talked about four financial statements: the income statement, which we spent quite a bit of time on, the statement of retained earnings, the balance sheet, which we've also spent a lot of time on, and now we're going to talk about that fourth financial statement, a very, very important one, the statement of cash flows. So we have some learning objectives here. I will let you look over those. But the statement of cash flows, we have a purpose for this statement, and so we're going to be getting into pretty much all of these. Given the nature of this course, we may not actually prepare a full financial statement of cash flows. But you should be able to do so if required. All right, so when we I want you to think for a moment about a balance sheet, and I want you to think of the very, very first item on the balance sheet under current assets, and that will be cash. So let's see what our slide says. It said the statement of cash flows reports a company's cash inflows and outflows for a period, and provides useful information about a company's ability to generate cash from operations. That just simply means doing what that business does. Whether we're talking about a merchandiser, a manufacturer, or service-related business, generating cash from operations is extremely important. A statement of cash flows will give us insight into a company's ability to maintain operations, to continue, to meet financial obligations, for example, if we have borrowed money from the bank, and to pay dividends. And when we talk about dividends, I want you to understand what we're talking about there is paying the owners distributions on their investment. We're not simply talking about situations where an individual has purchased, 60 shares of AT&T stock and they get a little dividend check, once every 3 months, something like that. We're talking about that, but we're also talking about situations where maybe a smaller business has an owner, and that owner periodically writes himself a check for $400 or $500, maybe $1,000 out of company earnings. So a statement of cash flows is useful in determining the ability of a company to do all four of these items. All right, so there are three types of cash flow activities. I want to tell you by far, we have got ahead of myself for a second. We have cash flows from operating activities, we have cash flows from investing activities, and from financing activities. We're going to look at all three of these, but I want you to understand, just from a business perspective, as a potential future investor in a company, cash flows in and out from operating activities are probably the single most important portion of the statement of cash flows, because that deals with, again, a company's ability to generate cash from conducting the ordinary course of business. Okay, so, and that's kind of what it says here. Cash flows from operating activities are the cash flows from transactions that impact net income for that company, regular transactions. So purchasing inventory and then the sale of that inventory as merchandise by a retailer is an example. Okay. Number two is investing activities. And these are cash flows from transactions that affect investments in the non-current assets section of the balance sheet for a company. The purchase and sale of fixed assets is a wonderful example. So we might buy some machinery, equipment, vehicles, whatever the case may be. That would be a cash outflow. when we eventually sell those off, because they've served their purpose, but they still have some residual value. If you recall from our discussion of non-current assets, well, that would be a investing inflow whenever we sell these fixed assets. And then finally, this is also a biggie, cash flows from financing activities. It says, for the example, this is how a company will raise money and then pay that money back. It says issuing or retiring equity and debt securities. Now, when we talk about equity, what we're talking about, and I don't want to get too much into this because this is an Accounting 1 class, and most of your discussion, at least at this school, on equity and debt is going to be in your Accounting 2 class. But if we can raise money, we can finance our activities by selling part of our company. That's called selling stock in our company, and that is synonymous with the word equity. Debt securities generally refer to bonds. You've probably heard of bonds. And so whenever someone issues a bond, they sell a bond for, say, $1,000. Well, they take that $1,000 and eventually they're going to pay that back plus interest. So another wonderful example of debt securities would simply be going to a bank and borrowing money. Okay. Here we have an example, and we'll have another example later on in the presentation. But I want to kind of skip down here. It says the ending cash on the statement of cash flows equals the cash reported on the company's balance sheet at the end of the year. Okay, so if we think about this, we're talking about this figure right here, this should match what is on the balance sheet, and it will. And so we have to ask the question, okay, that's great. But let's say that a company in 1 year had cash into the year of $50,000, and the next year they had cash at the end of the period of $150,000. Well, that's an income or a change of threefold. We went from 50 to 150, so we have 3 times as much cash. Why? Is it because we made a lot of profit in our and had a lot of cash flow from operating activities? Or perhaps did we sell a whole bunch of our fixed assets? Or maybe we went and borrowed a bunch of money, or even sold off some of the company. Okay, so all of these items, pluses and minuses, impact the change in cash. Okay, so in our example, let's just say that our cash at the end of the period here was $150,000, and the cash at the beginning of the period right here is $50,000. Well, that means that the change in cash right here is going to be $100,000 positive. So how did we get there? Which of these items here went up? Was it all 3? Was it mostly a financing activity? What was it that caused the change in cash to go up by $100,000? We might want to know that. A little vocabulary on this slide here. It says a source of cash causes cash flow to increase and is called a cash inflow. So cash inflow and source, those are synonyms. A use of cash causes cash flow to decrease and is called a cash outflow. So again, a cash outflow and a use of cash are synonyms. This slide provides you with some pretty typical examples of cash inflows and outflows for each of the 3 sections of the statement of cash flows. Operating inflows result from the sale of products or from providing some type of service. When we talk about sale of products, doesn't matter if we're manufacturing those as a manufacturer who then wholesales them, whether we're talking about a middleman or whether we're talking about a retailer. And then operating outflows, purchasing that inventory, paying employees, paying taxes, any of our normal operating expenses that we're going to ultimately pay in cash. Investing from the sale of property, plant, and equipment would be an inflow. When we buy that equipment, it's an outflow. Sometimes companies will have excess cash laying around, and we will purchase investments, hopefully to earn some money on that excess cash. Eventually, we're going to need that cash, and then we're going to sell it. That would be an inflow. We have our financing examples here. Issuing long-term liabilities. What they're talking about here is either issuing a note to a bank, a note payable to a bank, or for a long, that's for a period of more than 1 year, or bonds. And again, we haven't discussed bonds. You'll get into that later. And then issuing stock, financing outflows, paying dividends to shareholders of the company. Treasury stock is another concept that you're going to get into in your next class, but that's when a company buys back its own stock. And then to repay long-term liabilities. So in other words, we borrowed money from the bank over here. Now we're going to repay it here. So inflow, outflow. All right. Let's go ahead and get started on a discussion of cash flows from operating activities. We have two different methods for reconciling cash. We have what's called the direct method and the indirect method. In this class, we will only cover the indirect method in the interest of time. Okay, so let's see what it says here. It says reports cash flows from operating activities by beginning with net income and adjusting for revenues and expenses that do not involve the receipt of cash or payment of cash for the period as follows. So we have a 6-step process here. We're going to just look at our income statement, and we're going to look down to the very bottom, and we're going to look at net income. And that's going to be our starting point. Then we're going to look at our accounts receivable, and most of these items are going to move the opposite of what of how they would normally operate. So I want you to remember that this is the accrual basis of accounting. So let's think about accounts receivable for just a moment. Let's say that we have $100,000 of net income, but our receivables went from $50,000 at the beginning of the year to $60,000 at the end of the year. So they went up. That's going to be a negative adjustment of $10,000. Why? Because we're trying to reconcile cash. And part of that net income, roughly $10,000 of that, is from profits that have not actually been converted into cash yet. So when we have an increase in accounts receivable from the prior period, that is a negative adjustment. When we have a decrease in accounts receivable, that is a positive adjustment. What that means is we have actually collected some money overall. Let's say that, just to use a quick example, if accounts receivable was $60,000 at the beginning of the period and $50,000 at the end of the period, well, that means that essentially all of the cash that's in net income, or all of the accounts receivable from the current period, have essentially been collected, and then there was an extra $10,000 cash that we have to add that is not found in net income for the current year because it was from the prior period, last year. Okay, so an increase in accounts payable is an addition to cash flows under the indirect method. Think about your income statement. Think about utilities expense, and we have a utility bill for $1,000. Again, accrual basis of accounting. we know that we owe that, so we expense that $1,000 to the income statement, but we haven't paid that out in cash. And we're going to pretend that all of our accounts payables for the, at the beginning of the period, end of the period, everything was exactly the same, except for that one utility bill. Okay, so that one utility bill caused our accounts payable to go up by $1,000, but we haven't paid that out in cash yet. Therefore, it is a positive adjustment to cash, because that's what we're talking about reconciling, is cash. If we have a decrease in accounts payable, that means we've used some excess cash. Okay. Inventory is an asset, and it's done just like accounts receivable, which is an asset. If we have an increase in inventory, that would tend to indicate that we have spent more money on inventory than what we've actually been able to sell for cash. And so that is a negative increase. And then if our inventory has gone down, that's an indication that some of the inventory that we sold was purchased in a prior period. Okay. Depreciation expense, which is on the income statement under operating expenses, is a non-cash expense. Therefore, it is a positive adjustment to cash. And then finally, we have losses and gains. Okay, losses have a negative impact on net income, and gains have a positive impact on net income. However, losses and gains are an investing activity. Therefore, let's say that we have a situation where we purchased let's say we have a dry cleaning business, and we purchased a delivery van some years ago for $20,000, and we've depreciated that van all the way down to where it has a net book value of $5,000, and we sell that vehicle for $7,000. Well, in that situation, we're going to have a $2,000 gain that's going to increase net income, but it's not an operating activity, because we're not in the business of buying and selling delivery vans. We're in the business of dry cleaning clothing. So that $2,000 gain is a negative adjustment. Let's say that we sold that van for $3,000 with a net book value of $5,000. We would have a $2,000 loss, and we would add that to cash because it had previously had a negative impact on net income, but that was a cash flow from an investing activity, not from a operating activity. Okay. All right, let's go ahead and close this video out, and then we'll start with investing activities next, cash flows from investing activities next.